This physically driven gold rally has simply paused mid-rally, with fresh 2026 targets being assessed as high as $8,000. All our targets are still in place. This was the 3,800 level. One by one, these targets are getting hit. 3,800 for the 4,000 level. Now looking to still fulfill a 4,500 level, but just wanted as an aside. The point we're trying to make here is China has secured enough physical gold to be able to one-to-one pair its currency with physical gold. Now, the ability to enable seamless one-to-one instant conversion of the yuan to physical gold and or borrow against gold deposited in the expanding Western accessible SGE vaulting network instantly turns first-tier gold into a high-quality liquid asset.
In a recent discussion, market analyst Andrew Maguire shed light on a major turning point in the global gold landscape, one that could redefine the balance between East and West. According to him, the ongoing gold rally is far from over. It's merely paused mid-rally as new long-term targets emerge, potentially soaring toward $8,000 per ounce by 2026. Previous benchmarks such as $3,800 and $4,000 have already been met, and projections now point toward the $4,500 level as the next milestone. But what's most striking is the underlying force behind this momentum: China's quiet accumulation of physical gold. Maguire emphasizes that the nation has secured enough reserves to effectively back its currency one-to-one with gold, a move that could send shockwaves through global finance. The establishment of a gold-backed yuan, supported by seamless conversion and borrowing through the Shanghai Gold Exchange's expanding vaulting network, transforms gold from a mere investment into a high-quality liquid asset. This strategy positions China not just as a buyer, but as a structural force reshaping the future of monetary stability. The implications are profound. A coming era where physical gold may once again define the foundation of value. Stay informed, stay prepared, and don't forget to like, share, subscribe, and comment below with your thoughts.
China has now gained full control of the physically settled gold price setting mechanism, and to accommodate Western-facing participants who are in the advanced stages, they're opening up the Western-facing global gold corridor. Liquidity providers estimate silver will regain and test its all-time highs by the end of the year, and this time assisted by competitive short-stop hunting with far too few rinsable specs to flush next time. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside of the CME LBNA ring fence, the stealthy gold revaluation process that already commenced directly after the BIS revalued gold has gathered sufficient global momentum to force the US Treasury gold to be competitively revalued. Once it's revalued, the US will want a stronger gold price. And as we've been drawing attention to, every single non-dollar denominated fiat gold price, pound, yen, whatever, euro, whatever you want to look at, has been dragging lagging dollar gold price into its all-time highs. They've all been into all-time highs way before gold did. And yes, we will see from time to time the US is able to push back the dollar gold price from time to time, as we likely see again today into gamed FOMC volatility. But it's limited to how much COMEX derivative open interest can be laid off against a dwindling number of speculators siloed outside the real market price setters. They don't even know what that price is. And as we've been focusing on, the real game changer is that China took off the gloves the moment the yuan gold became fully Basel III compliant, and opening up Western-facing institutional grade one-to-one ability to one-to-one vault their bullion in vaulting facilities, which are able to eliminate unallocated gold counterparty risk, creates a much more stable environment. Your gold is stored in physical environment. China has accumulated sufficient physical bullion to price its debt-free gold currency, foreign exchange cross, against the debt-riddled dollar and US treasuries to be able to retaliate against flip-flop uncertainty of US sanctions. The ability for central banks, sovereigns, and all categories of Western-facing global investors, hedgers, producers, etc., to be able to treat gold as a high-quality liquid asset on their balance sheet is driving the next wave of gold demand sufficient to discover a gold price that doubles current estimates. This Financial Times assessment here illustrates that foreign central banks now hold more gold than the US Treasuries. However, given this official data fails to include thousands of tons of unreported monetary gold central bank buying, and with China alone securing a conservative 80,000 tons, and Russia, India, Saudi, and the BRICS another 30,000 tons, the percentage is far likely closer to 60% and rising. Now, in the meantime, Chinese and Indian gold and silver buying continues to compete with Western ETF demand. Gold is not rising. It's simply evidence that the dollar is being diluted with gold holding its purchasing power. It's that simple. So the de-dollarization process is a natural event. And circling back to who and what was likely behind the official gold pushback against an out-of-control China-orchestrated BRICS plus dollar to gold de-dollarization escalation, i.e. just swapping dollars for gold, of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, which will actually be enormously beneficial for the dollar, it'll soon be revealed that as yet unseen central bank, sovereign, and institutional buyers are quietly converting a rising dollar. A lot of this has happened into a rising dollar. What do you think they're doing? They're saying, yeah, while the automated spec sellers will say, hey, dollars rising, sell gold, dollars rising, sell silver. But what the real money is doing is saying, hey, we've got a rising dollar. Hey, what an opportunity to convert dollars into gold, into silver. So you're kind of sometimes seeing that correlation really breaking apart. So what this does is set up a competitive short stop rinse to the upside, setting up the next higher physically determined spec-free, I will add speculator-free price to rally from before the next round of hot money sets itself up for a fresh long stop rinse again. Now, while this old school legacy market pushback is being orchestrated in sync with every media outfit calling gold a meme-like bubble, in reality, from a paper to physical perspective, we've been evidencing what is really a necessary and very constructive 96% leveraged long stop flush and an equally ballooning 96% spec naked short positioning. Now, the media has been likening this price smash to struggling to find some sort of parity to what's happened in the past, even though things have changed so rapidly. So,
in a rapidly changing financial landscape, China has now secured full control of the physically settled gold price mechanism, reshaping how the global market values precious metals. By expanding a Western-facing global gold corridor, the country has effectively opened access for international participants to trade and vault gold directly through the Shanghai network, a move that signals a profound shift away from Western dominance of gold pricing. Liquidity providers expect silver to retest its all-time highs by year-end, supported by stronger physical demand and fewer speculative players. At the same time, the real supply-driven gold price emerging outside the traditional COMEX LBMA system is forcing the U.S. Treasury toward an inevitable competitive revaluation of its own gold reserves. As central banks, sovereigns, and institutions increasingly treat gold as a high-quality liquid asset, the foundation for a repriced global gold standard is quietly forming. The data now shows that foreign central banks collectively hold more gold than the United States, and unofficial holdings may push that number much higher. What appears to be a gold rally is, in truth, the dilution of the dollar's purchasing power. A clear signal of global de-dollarization underway. Let's get into the interview.
This move took out most of the October move higher, but in the process of shaking out the speculators, and then we always said these speculators are the problem, but after shaking them down, what that's done is there's been a wealth transfer of gold and silver from weak hands into strong at a higher physically supported rally point. Now, while the 10% top to bottom correction has cleaned out all the froth and has now wrong-footed these same leveraged actors to flip from naked long and chasing it up to naked short and chasing it down, this naked short sell gold and silver is occurring. It's being taken up by very strong physically held hands, and they haven't gone away. And it also did not go unnoticed, though. We're going to connect all the bits here. That the trigger point to target these ballooning speculative positions was timed with Trump's China posturing. Now, it's all connected in combination with very fresh weaponized geopolitical energy sanctions. That's primarily to put pressure on the core Russia, India, BRICS fulcrum, the RICS portion of the BRICS fulcrum. Trump was also attempting to push back against the gold-rich BRICS alliance. Now, what is visible is, alongside the weaponizing of energy geopolitical sanctions, billions of dollars of COMEX gold and silver were created and sold into the market to cap the gold price from breaking above 4,400. Risking, because really 4,400, I mean, that was risking forcing the Fed to buy back upcoming end of month borrowed Bank of International Settlements gold bets at over $600 higher than last month's 4 tons being squared $409 at a loss. Now, the Fed is the only central bank still fighting a rising gold price, and it's completely mishandled the US Treasury's gold positions. And with 30 tons still to be bought back, plus billions of dollars of the Office of the Comptroller bets, the OCC bets that are visible to anyone, these bets directly relate to US Treasury rehypothecations, double ownership. So really, what it's potentially doing is facing a default into this incredible physically supported rally. Obviously, a portion of that was not the physical buyers. These two margin increases and a bid pulled event. And as soon as that was announced, in combination with, and bearing in mind these market makers have a footprint in both the COMEX and London, we're looking at the COMEX market here, the derivative market, in combination with some bid pulling, and these specs having sucked in naked long, they pulled the plug on these massive leveraged positions. And where did we go to? A complete gap close. And this margin increase here had increased costs to borrow by $3,000 per contract to $20,000 to run that contract. As I say, this was enough. These speculators are leveraged using the prior profits to continue to leverage. So this was a classic rinse out. And given enough speculators had leveraged themselves long using paper profits to add more borrowed gold to the limit, this margin increase, along with strategically timed pit manager bid pulling, this borrowing cost to increase was designed to trigger a self-fulfilling waterfall spec long stop ignition. So the subsequent full circle retracement, basically, of the 3-week rally, and it was a 3-week rally all the way to this point here, around about the 5th. And this can be summed up quite simply. A full gap close flush, with the speculators from the commencement of the October rally all getting rinsed out. And, as is always the case, momentums are always wrong at both ends of a move. And by definition, they don't like sideways action. So they were forced into a pillar-to-post rinse and immediately took the other side and bet naked short. So really, probably around about this level here, all the specs, the longs were pretty much rinsed. Then you've got a couple more come in.
The recent correction in gold and silver wasn't a setback. It was a strategic reset. What seemed like a 10% shakeout was, in truth, a transfer of wealth from weak speculative hands to strong physical holders. This flush exposed the instability of over-leveraged players, flipping them from naked long to naked short, while the real demand quietly strengthened beneath the surface. A Amid this volatility, geopolitical pressure played its part. Coordinated moves, from energy sanctions to tactical market interventions, worked to suppress gold's momentum just as it threatened to break higher. Yet, this effort has only intensified the physical market's foundation, as global buyers step in where paper markets falter. With rising borrowing costs and margin hikes triggering a cascade of forced liquidations, speculative excess has been drained out. Now, gold and silver sit poised on a more solid footing, a physically backed rally base, ready for the next leg higher. The short-term noise may favor traders, but the long-term signal is clear. Strong hands are accumulating. The era of paper dominance is fading fast. Stay informed, stay prepared, and don't forget to like, share, subscribe, and comment below with your thoughts.